For today's video, I'm going over my top 7 stocks for February of 2022. I've looked at hundreds of companies and have compiled a list of stocks that I believe should be on your radar. I strongly advise you stay tuned to the end to hear my full review of each of these businesses. I'll go through some recent critical growth factors and why these companies are predicted to grow. But before we begin, make sure to keep yourself informed and engaged by subscribing to the channel and turning on all notifications so you won't miss our latest uploads. The first stock we'll discuss today is the Bank of America, which trades under the symbol BAC. Bank of America is a multinational investment bank based in the United States, making it one of the world's largest financial organizations. Bank of America has already demonstrated its endurance over the last decade with a 700% increase in value and a comfortable return from pre-recession levels. Bank of America's position as one of the top 10 most prominent financial institutions in the world by total assets is just one more example of the company's tenacity. CEO Brian Moynihan has been in charge of the company's redemption arc since 2010. He has made it clear that he wants to stay at the corporation's helm. Given that Bank of America was able to claw its way out of its economic hole, I believe the CEO knows what he's doing. In the future, we can expect similar beneficial outcomes. Now, in addition to its durability and endurance, we should search for reasons why Bank of America's stock will rise in the following year. Rising interest rates are one big prospective element that makes me optimistic about the company. The Federal Reserve has declared that it will raise interest rates in 2022 to keep up with inflation. We fully anticipate financial companies like Bank of America to benefit from that. We also can't overlook the increasing inflation that will definitely lead to higher consumer costs. This may require customers to borrow more money from banks. This is just another positive indicator for Bank of America, which we should anticipate in 2022. Overly high interest rates, of course, benefit no one. However, when we look at mortgage rates, we can see that they are currently at historic lows. In other words, now is perhaps the best time to raise rates again. Interest rates are unlikely to hit a dangerous high anytime soon, therefore we shouldn't be concerned. Returning to Bank of America's previous performance, the company recently released its Q4 2021 earnings. With a net income of $32 billion on sales of $89.1 billion, the company declared a record year, with rises in deposits, loans, and leases seen throughout the year, with values approaching pre-pandemic levels. In other words, individuals are once again willing to spend money, and Bank of America is directly benefiting from this spending spree. We have many reasons to anticipate that Bank of America will maintain its current level of performance and will find numerous profitable chances this year. I don't see why it wouldn't be beneficial to have BAC on our radar for the time being. The second stock we will be discussing today is Meta Platforms, which trades under the symbol FB. Meta is a multinational tech conglomerate based on the United States, known as Facebook. While Meta stocks may continue to fall for the next 3 months, it is still undervalued. Mark Zuckerberg, Meta's founder and CEO, made it clear that Facebook changed its name to Meta to signify its dedication to the metaverse growth, and we can see this dedication reflected in more ways than just the name change. Even though Facebook's name has only been changed for a few months, Meta has already proved its commitment to the metaverse's future by purchasing Oculus and Horizon VR technology. Mark Zuckerberg recently revealed that Meta is working on the world's fastest AI supercomputer, and while the effectiveness of this initiative is still debatable, the fact that he made such a significant revelation in the first place shouldn't be seen as a PR stunt. It wouldn't be unrealistic to expect some new Meta platform technologies to emerge in the future. While we can concentrate on the futuristic projects Meta has been working on for a long time, it's important to remember that Meta was previously Facebook, one of the world's largest digital and social media corporations. They still have control over Facebook, WhatsApp, and Instagram. Despite of all of its latest metaverse advancements, Meta is still very much a social network firm. Plus, I like to think that Meta's enormous user base provides the organization with the necessary finances, resources, and clout to move forward with the big projects it's been working on, particularly the metaverse. Investors are hoping to see higher profits on paper as well. Several analysts predict that Meta will outperform expectations. We won't know for sure until we see the results ourselves. Anyway, I'm confident in Meta as a long-term investment because the firm is already well established and is clearly focused on the future of business and technology. Bristol-Myers Squibb, stock ticker BMY, is the next company on the list. This is an American pharmaceutical firm that is also one of the largest in the world because it has 3 products that have already contributed significantly to its success. To begin with, Bristol-Myers Squibb is the company behind the oncology medications Opdivo and Revlimid. Both of these drugs have long been regarded as powerful cancer therapies. They're also recognized for developing Eliquis, an anticoagulant medication. Unfortunately, the patents on these medications are about to expire. But in addition to these 3 pharmaceuticals, BMY is an excellent firm because it has a portfolio of items ready to generate even more money for the company. The company is now developing Reblozyl, a blood therapy medicine that the company estimates will produce more than $4 billion in yearly sales by 2029. They also have mavacamten, a possible therapy for symptomatic obstructive hypertrophic cardiomyopathy. This medicine could be approved by the FDA this year. If it succeeds, the corporation anticipates annual revenues of at least $4 billion to resume in the not-too-distant future. Finally, the corporation has produced this new medicine, which unfortunately I cannot pronounce for the life of me. It does, however, begin with a D. This is a potential psoriasis medication that could be approved by regulators in the United States and Europe later this year. It's amazing because their medicine is more successful than one of the most popular psoriasis therapies on the market right now, making it a competitive force against more thorough treatments. Another feature I admire is that they are well known for forming strategic alliances with other pharmaceutical and medical companies. For instance, the business recently collaborated with Century Therapeutics to license CRT cancer projects, and then put another $15 million to a cancer treatment program in this arrangement. This demonstrates its wealth of resources and ability to reinvest them in other profitable ventures. Keeping this stock on your watch list for at least a year can be beneficial. This is a fantastic company that I will surely be keeping an eye on. Next up is Charles Schwab with stock ticker SCHW. Charles Schwab is an American financial services firm specializing in banking, consulting, and asset management. It's easy to see why Charles Schwab is one of the country's top brokerage firms. To begin with, their investment services continue to compete with the industry's most potent competitors as well as the most promising entrants. As an investment broker, the organization indeed provides an all-in-one financial solution. They have seen extraordinary growth in the last year, with a value increase of approximately 67%. The business's earnings season was the catalyst for this gain. The company reported a record $1.58 billion in net income on $4.71 billion in revenue, up 39.21% and 12.74% year-over-year, respectively. The acquisition of TD Ameritrade by Charles Schwab in 2020 aided the company's future prospects and growth, as TD Ameritrade is a well-known financial brokerage platform. In 2021, Charles Schwab opened millions of new brokerage accounts through TD Ameritrade and its own platform. This demonstrates the company's long-term viability. As investors, we can be confident that Charles Schwab will continue to reign as one of the country's leading brokerage businesses for a long time. Because 2022 is expected to be a high-interest year, as I previously stated, we should see some favorable benefits from this stock. If you're looking for a long-term investment opportunity, I believe SCHW would be an excellent fit for you. Lemonade, with stock symbol LMND, is next on the list. Lemonade is an insurance company based in the United States that provides various insurance products and services, ranging from renters and homeowners insurance to auto and pet insurance. Lemonade has reverted to its initial public offering price, which isn't fantastic news given that it has topped $180 per share. While many investors were concerned about the company's mounting losses, failing growth, and acquisition of Metromile, it may be premature to write off Lemonade entirely, given the company clearly has space to develop and its share price is currently being sold at a significant discount. To give you a bit of context, Lemonade is a company that caters primarily to young people and first-time insurance purchasers. During the company's rise, the trend was noticed years ago. These market trends don't go away after a year or two, and I believe Lemonade's insurance brand will continue to appeal to a growing number of young people. Another essential point to examine is that Lemonade still has the ability and desire to develop its business and product line. This indicates that the corporation still has a reservoir of resources from which to work with and has additional ambitions for the future. Let's start with what the organization already has to offer. They're well recognized for supplying renters insurance at a lower price than the competition. However, the insurance firm also provides homes and pet insurance. Bullish investors are interested in seeing how Lemonade leverages Metromile's resources to grow in its newest product, vehicle insurance, following its contentious acquisition. Millions of vehicle trips and billions of miles have already been logged using Metromile technology and databases. With this, Lemonade has access to a wealth of auto data that can help services, particularly when completing claims. According to bullish investors, Lemonade is also a fully disruptive startup in the insurance industry. That's where the two distinct causes come into play. The first reason is that Lemonade uses artificial intelligence for its transactions. Artificial intelligence makes its judgments, allowing to provide rapid and efficient services. They can make decisions in a matter of minutes, and their claims process is also considerably more straightforward. The company's business strategy differs from other traditional insurance firms, which is the second reason that Lemonade is disruptive. While other companies collect money after claims are paid, Lemonade collects premiums up front and donates any money left over to charity after claims are paid. While this is definitely a more speculative firm that has yet to prove its competitive viability in its own field, I believe Lemonade has a fantastic risk-reward ratio, assuming that they will be able to fully convert into vehicle insurance. In that event, I believe investors will almost surely profit. Of course, as I previously stated, this is a highly risky investment at the moment. Still, it's absolutely worth keeping an eye on. Next stock we're talking about is Procter & Gamble, stock ticker PG. Procter & Gamble is a multinational consumer goods company based in the United States, specializing in personal health and hygiene products. Procter & Gamble is also one of the world's oldest corporations. While we might not expect groundbreaking innovation from a company that focuses primarily on personal health and hygiene products, investors ought to be surprised that a company like Procter & Gamble has not only stood the test of time, but has also weathered the storm of challenging economic conditions. To begin with, it's very remarkable that a firm as old and ordinary as Procter & Gamble was able to fully catch up with the S&P 500 during its most recent 5-year bull run. P&G in particular has grown at a steady but significant rate of 82% over the last 5 years. They've also had to deal with severe economic challenges, such as rising inflation rates, driving up material costs. Nonetheless, the corporation has demonstrated its resilience by adapting to these circumstances, whether by raising product prices, decreasing costs, or saving money in other areas, as well as including premium high-demand fabric care and skincare items into their portfolio. As a result, sales targets are being exceeded. They claimed a 6% growth in organic sales, with success in the fabric and home care sectors and the company's healthcare needs. This infographic is from P&G's most recent earnings release, showing a 95% rise in free cash flow productivity. So, what does this mean? Free cash flow productivity refers to Procter & Gamble's ability to convert earnings into free cash, which may subsequently be given to creditors or investors like us who put money into the company. Because Procter & Gamble pays dividends to its shareholders, this is ideal. A quarterly dividend of 86.98 cents per share was just issued by the corporation. Another compelling argument to acquire P&G stock is the company's dividend payout. Overall, I believe they're a long-lasting and obviously robust corporation with a vast inventory of products that people will almost certainly always require. Last but not least is Kinder Morgan, stock ticker KMI. Kinder Morgan is an energy infrastructure firm based in the United States that owns and operates oil and gas pipelines and terminals. When it comes to dividends, KMI is one of the most dependable stocks you can ever hold. To put things in perspective, Kinder Morgan owns and maintains the largest natural gas pipeline network in the United States. Its business model is distinct from other energy companies, but it's also quite predictable. Kinder Morgan makes money by entering into long-term contracts that allow it to estimate its projections and figures. When the COVID pandemic struck in the spring of 2020, Kinder Morgan revised its whole financial forecast for the remainder of the fiscal year. And by the conclusion of the fiscal year, the company's original April guides have been proven to be over 99% accurate. This is ridiculous, especially given that they were operating when the economy was highly volatile. This is a testament to the company's long-term viability and predictability. While some investors might find it quite boring, I find it quite enticing that a corporation can actually explain to investors exactly what to expect from the company's business and profits. Kinder Morgan has previously published its full year 2022 guidance for investors to review. However, the business expects increased EBITDA, earnings per share, net income, and full-year dividend per share compared to the previous year. It's fantastic that they're assuring investors that this year's results will be even better than last year's. Even though they've already so stable and long-lasting, I admire how they're continuing to grow their company. For example, in the last year or two, they've completed some essential purchases that positively impact the company's future prospects. For example, in July 2021, they purchased Stagecoach Gas Services, which analysts believe will play a key role in developing Kinder Morgan's Northeast area by building more pipeline miles and deploying more energy storage facilities. In August of 2021, Kinder Morgan bought Kinetrex Energy to trap methane emissions from landfills and convert them into usable energy. To put it another way, the firm has achieved a delicate equilibrium between two universes. In one world, they're incredibly predictable. On the other, Kinder Morgan continues in developing its operations and network across the continent. They made it clear that they wanted to build shareholder value through dividend payments, rather than just stock price increases. Fortunately, the firm just announced a 0.27 per share dividend, which it has been able to maintain because of solid cash flows and strong balance sheets. For all of these reasons, I believe KMI is deserving of your attention. That concludes my top 7 stocks for February 2022. However, before investing in any company, you should conduct your own due diligence. I'm not a financial consultant. This is not intended to be taken as financial advice. Instead, it's a review of 7 different firms that I adore as of the moment. That's it for today's video, guys. Thank you so much for watching. If you like the video, hit the notification bell and turn on all notifications so you can stay up to date with our latest uploads. And of course, like, share, and subscribe. See you guys in the next one, and remember, keep living life bullish.